With major changes in tax law over the last few years and an upcoming potential reduction in the gift and estate tax exemption, year-end gifting has become an essential tool for safeguarding your wealth and reducing estate taxes. By acting proactively and strategically now, you could literally save your heirs millions of dollars and ensure that your legacy is protected from unnecessary tax hits. In today's video, I'll dive into the key strategies you can use before year-end to maximize these benefits and seize these fleeting opportunities while they are still here. Let's get started. Before we dive into the specific strategies, it's crucial to understand why proactive planning matters, especially now. Every time you transfer wealth, whether through gifts during your lifetime or through your estate after death, there is a transfer tax involved. These transfers are taxed differently, but they both use up a shared exemption. Right now, the unified gift and estate tax exemption is set at $13.61 million per person, double for married couples, and it also covers the generation skipping transfer tax for gifts to skip persons, such as grandchildren. In 2025, the exemption increases slightly to $13.99 million, but in 2026, it's set to be cut in half, dropping to around $6.5 to $7 million per person under the Tax Cuts and Jobs Act sunset provision. This creates a limited window for substantial tax-free wealth transfers, and waiting until after 2025 means risking the chance to maximize this use it or lose it exemption. Doing nothing could cost you millions in avoidable taxes, too high of a price to pay for inaction. Let's look at two scenarios. In the first, you do nothing. When the exemption drops to $6-7 million in 2026, you lose the chance to transfer $7 million tax-free, potentially leading to $2.8 million in federal estate taxes. In the second scenario, you transfer $7 million now before the TCJA expires and hope it's extended. If luck is on your side and the TCJA is extended, you'll have $7.61 million unused exemption remaining, adjusted for inflation. But if the TCJA sunsets and the lifetime gift exemption is reduced, that unused portion will be lost and no new exemption amount will be provided. In other words, it comes down to choosing between a bird in the hand or two in the bush. And that's why proactive planning is so crucial now. Another reason to act now is that the IRS is stepping up its focus on high net worth individuals and complex financial structures, especially partnerships and entities with large assets. They are using AI and machine learning to track down inconsistencies or questionable transactions. That means keeping your financial and estate planning up to date and well documented is more important than ever. This is where valuation discounts like those used to reduce the taxable value of assets transferred through trusts may come under more scrutiny. Working closely with your financial advisor, tax professionals, and estate planner ensures everything is correctly reported and compliant. Proper documentation, including gift tax returns, is essential to avoid complications during an audit. Even if you don't have a huge estate, balancing estate and income taxes is critical while planning your gifts. Assets transferred during your lifetime to your loved ones or a trust are given a carryover basis, meaning the recipient gets your original purchase price as the basis. When they sell, this could trigger significant capital gains taxes. In contrast, assets passed on at death receive a step up in basis, meaning the beneficiaries inherit the assets at its current market value, potentially avoiding capital gains taxes. You need to weigh the benefits of reducing your taxable estate through lifetime gifts against the potential for high capital gains taxes later. Capital gains taxes are usually lower than estate taxes, but are taxed from the first dollar of gain. On the other hand, estate tax is currently at 40%. But only triggered after exceeding the exemption amount. Here's a strategy to help manage this. If you transfer an asset during your lifetime and later realize it has appreciated significantly, a substitution power within a trust allows you to swap it for another asset of equal value. This helps you avoid losing the step up in basis while keeping flexibility in managing taxable gains. As you can see, it's crucial to structure trusts with built-in flexibility, so adjustments can be made as circumstances change. This ensures you are not locked into decisions that may no longer make sense in the future. Even though the federal exemption is high, many states have their own estate taxes with much lower exemption limits. Unlike the federal level, where portability allows a surviving spouse to use the deceased spouse's unused exemption, most states do not offer this. This is why electing portability at the federal level can be crucial, especially if you want to ensure both spouses' exemptions are fully used. In blended families or second marriages, setting up bypass or credit shelter trusts can prevent unintentional disinheritance and still reduce estate tax liability. If you are a snowbird splitting time between states, residency issues can complicate estate planning. For example, you might claim Florida residency to avoid state income taxes, but another state could argue you are still domiciled there. It's essential to establish clear proof of your intended residency, including where you vote, hold your driver's license, and maintain significant assets. For instance, in Illinois, while there is no gift tax, a 3-year rule exists that can pull gifts made within 3 years of death back into the estate for state tax purposes. Without proper documentation and planning, this could result in paying estate tax in Illinois without receiving credit at the federal level. When it comes to making lifetime transfers before the year ends, you have several options. Annual exclusion gifting is an easy way to reduce your taxable estate without having to file a gift tax return. But the key is to act before the year ends. For 2024, you can give up to $18,000 per person tax-free. Just make sure the gift is completed before December 31st. This means the recipient must actually receive and take possession of the gift by year end, whether that's retitling property or cashing a check. If you are making more complex gifts, like gifting business interests using valuation discounts, make sure to report them to start the IRS statute of limitations. That way, the IRS has only 3 years to challenge the gift. Another strategy for your year-end gifting and estate reduction involves qualified transfers. For example, you can pay certain expenses, specifically tuition and medical costs, directly to an institution without incurring gift tax, generation skipping tax, or using up your annual gift exclusion. Charitable contributions are another impactful way to give. Although there are limits on income tax deductions, gifts to qualified charities are typically exempt from transfer taxes. One effective strategy for year-end gifting that I like is called front-loading a 529 plan. The IRS allows a contributor to make up to 5 years' worth of annual gift exclusions in a single upfront contribution, enabling substantial gifting without affecting the lifetime exemption. For example, in 2024, you can transfer $90,000 out of your estate to your child's or grandchild's 529 plan. If you want to amplify your giving, you could contribute $18,000 at the end of December and superfund in January, effectively covering 6 years of gifting within a short time frame. Keep in mind that if the contributor passes away within 5 years, any unused portion of the gift could revert to the taxable estate. A crummy trust is a popular estate planning tool that enables individuals and families to transfer wealth to future generations in a tax-efficient way. The defining feature of a crummy trust is that beneficiaries must have a brief window, typically 30 to 60 days, to withdraw the gifted amount for it to qualify for the annual gift tax exclusion. When gifting partnership interests in family-owned businesses or making similar contributions to a crummy trust with multiple beneficiaries, timely notifications is essential. Beneficiaries should be notified in advance so they have enough time to decide whether to exercise this withdrawal right or not. If the crummy notice isn't sent on time, you could lose the annual gift tax exclusion for that year. Also, be sure to keep detailed records to protect against any IRS challenges. A similar process applies to irrevocable life insurance trusts, where grantors make contributions to cover premium payments. However, waiting until the last minute to fund the trust can backfire, as the annual gift exclusion may not apply if the crummy withdrawal period does not expire before the year's end. To avoid issues with the IRS, I will repeat myself. It's essential to send crummy notices early and maintain records of the notification dates. For larger estates, an intentionally defective grantor trust is a powerful tool for transferring wealth. The term defective in the name often raises concern, with people fearing they might be doing something improper. In reality, there's nothing wrong or illegal about using this strategy, because intentionally defective grantor trusts are a type of grantor trust governed by rules in sections 671 through 678 of the tax code. The defect is intentional and has more to do with the way the trust is treated for tax purposes. For estate tax purposes, the transfer to the trust is considered complete, meaning the assets are removed from the grantor's taxable estate. However, for income tax purposes, the trust's income is attributed to the grantor, who pays income tax instead of the trust. This can actually be a strategic advantage known as tax burn. By paying taxes on the trust's income, the grantor effectively reduces their taxable estate while allowing the trust assets to grow for future generations. Along with the tax burn, an IJIT can further maximize its benefits with freeze and squeeze strategies. The freeze strategy involves transferring assets out of the estate at their current value, effectively freezing their value for estate tax purposes. Any future appreciation on the asset then escapes estate taxation and instead benefits the heirs. But keep in mind that transferred assets won't qualify for a step-up in basis for capital gains, since the carryover basis applies. The squeeze strategy further reduces the asset's current value by applying discounts and other valuation techniques, such as for lack of marketability or control, which lowers the amount subject to estate or gift taxes. Transfers to IJITs are particularly effective in low-interest environments, but even during high-interest rate periods, combining tax burn, freeze, and squeeze strategies can effectively shrink your taxable estate, maximize the value passed to beneficiaries, and reduce overall tax liabilities. Another variation of the IJIT is the spousal lifetime access trust, where the grantor's spouse is a beneficiary. By transferring assets to a SLAT, the donor spouse can remove these assets from their taxable estate, potentially reducing estate taxes, but at the same time continue indirectly using the asset despite it being in the trust. In today's higher interest rate environment, a charitable remainder trust can be an effective tool for charitable giving. A CRT is a split interest trust that allows you to transfer assets into the trust, receive income for a specified period, and then direct the remaining assets to a charity. Higher interest rates increase the value of this remainder portion, potentially enhancing your income tax deduction and reducing estate tax exposure. In essence, the higher the rates, the greater the potential benefit for both your income tax and estate planning objectives. To wrap it all up, the window for taking advantage of today's high exemption may potentially close if the Tax Cuts and Jobs Act sunsets in 2025. If you wait, you may face millions in unnecessary estate taxes, whether through outright gifts, trust strategies, or advanced techniques like IJITs and SLATs. The time to act is now. With the IRS increasing scrutiny and interest rates fluctuating, it's essential to make well-documented, thoughtful decisions before the year ends. Make sure to work with your financial advisor, estate planner, and tax professional to get your gifting strategy in place before December 31st. The sooner you act, the better positioned you'll be to pass on wealth tax efficiently to your loved ones and causes you care about. That's it for today. If you found this video helpful, please give it a thumbs up and subscribe to the channel. And if you're looking for guidance on estate planning or exploring tax-efficient wealth transfer strategies, feel free to schedule a complimentary estate clarity meeting. I'll leave the link in the description below. Thanks for watching.